Welcome back to our channel, traders and investors. Today, we're diving into the fascinating world of technical analysis. Whether you're a beginner looking to understand the basics, or an experienced trader seeking to refine your skills, this tutorial will provide valuable insights into reading charts, using indicators, and recognizing patterns. So, let's get started. First, let's talk about reading charts. The most common type of chart you'll encounter is the candlestick chart. Each candle represents the price action over a specific period, such as 1 minute, 1 hour, or 1 day. The body of the candle shows the opening and closing prices, while the wicks represent the high and low prices. A green or white candle indicates that the closing price was higher than the opening price, suggesting bullish sentiment. Conversely, a red or black candle shows that the closing price was lower than the opening price, indicating bearish sentiment. Next, let's add some indicators to our chart. One of the simplest and most effective indicators is the moving average. It smooths out price data to help you identify trends. A common strategy is to use a combination of short-term and long-term moving averages. For example, a 50-day moving average and a 200-day moving average. When the short-term moving average crosses above the long-term moving average, it's called a golden cross, and is considered a bullish signal. Conversely, when it crosses below, it's called a death cross and indicates bearish sentiment. Another popular indicator is the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements on a scale of 0 to 100. Traditionally, an RSI above 70 indicates that a stock is overbought, while an RSI below 30 suggests that it is oversold. This can help you identify potential reversal points. Bollinger Bands are another useful tool. They consist of a middle band, which is a moving average, and two outer bands that are standard deviations away from the middle band. When the price moves towards the upper band, the asset may be overbought. When it approaches the lower band, it may be oversold. Bollinger Bands can also help identify periods of high volatility when the bands widen, and low volatility when they contract. Now, let's move on to chart patterns. Patterns can give us clues about future price movements. One classic pattern is the head and shoulders. This pattern typically indicates a reversal from a bullish to a bearish trend. It consists of a peak, the head, between two smaller peaks, the shoulders. The neckline, which connects the lows of the pattern, acts as a key support level. A break below this line confirms the pattern and suggests a potential sell-off. Another important pattern is the ascending triangle. This is usually seen in an uptrend and suggests continuation. It is characterized by a horizontal resistance line and an ascending support line. As the price bounces between these two lines, it builds up pressure. A breakout above the resistance line signals a continuation of the uptrend. These are just a few of the many tools and patterns available in technical analysis. By combining these techniques, you can gain a deeper understanding of market movements and make more informed trading decisions. Remember, no single indicator or pattern is foolproof, so always consider multiple factors and stay updated with market news. Thanks for watching. If you found this tutorial helpful, please give us a thumbs up and subscribe to our channel for more trading tips and strategies. Drop your questions in the comments below, and we'll be happy to answer them. Until next time, happy trading! Don't forget to hit that bell icon to stay updated with our latest videos.